All right, let's talk about something you've probably never heard of, but that affects some of the biggest companies in the world, GILTI. It's a powerful, kind of complicated tax rule, and it all got started with a really interesting question.
So picture this. What if a massive tax cut, one designed to do something really good, like getting companies to bring money back to the US, actually, by total accident, created an even bigger, more tempting reason for them to stash their profits overseas? It sounds kind of crazy, right? But believe it or not, that is exactly what happened, and it set the stage for GILTI.
Okay, so let's dive into the nitty-gritty of this. To really get what GILTI is all about, we have to rewind a little bit and look at the problem it was created to solve. And our story really kicks off with a huge change in U.S. tax policy back in 2017.
So back then, the big idea was pretty simple. How can we get U.S. companies to bring all those profits they're making overseas back home to America? To do that, the huge tax reform bill, the Tax Cuts and Jobs Act, you'll hear it called the TCJA, introduced a really powerful new tool.
And wow, this slide really shows you just how big of a deal this was. Before 2017, if a U.S. company wanted to bring profits home, they'd often face a U.S. tax bill on that money. That's why trillions of dollars were just sitting in accounts overseas. But after the TCJA, a new 100% deduction meant that money could come flooding back completely tax-free. Sounds great, right?
But, and this is a huge but, there was an unintended consequence. If bringing money home from anywhere is now tax-free, what's to stop a company from moving its most valuable assets, the things that aren't bolted down, to a country with a 0% tax rate? We're talking about things like software, patents, brand logos, intangible assets that generate massive profits. This created a brand new, super-powered loophole for all this mobile income.
So yeah, this new loophole was a massive problem. Congress had to do something to plug the hole, right? They needed some kind of a backstop, a way to make sure that U.S. companies paid at least a little bit of tax on these foreign profits, no matter where they were technically earned. And their solution? They called it GILTI.
So what exactly is GILTI? Well, in the simplest terms, it's a rule that basically says to big companies, hey, we don't really care where you say you earned your profits. If you're a U.S. company making certain kinds of money in low-tax countries, you're going to pay some U.S. tax on it. It basically acts as a global minimum tax. The whole point here, the entire goal of GILTI, is to make those zero-tax countries way less appealing. The idea is to level the playing field, making sure there's a base level of tax on those offshore profits, especially the ones that are super easy to move around. It's a direct counterpunch to that new loophole.
Okay, so this is where it gets really, really clever. How does the tax code figure out what income is coming from, say, a patent versus a factory? I mean, it's not like money has a label on it. Well, it uses this super smart indirect method to guess.
And this quote from the IRS itself kind of gives away the game. It says, the law doesn't try to identify intangible income. Instead, it approximates it. So how in the world does it do that?
It all starts with the stuff you can actually touch, tangible assets. Think factories, heavy machinery, big office buildings. The law makes a pretty simple assumption. These physical things should make a predictable, kind of normal amount of money. That's the baseline.
And the tax code actually puts a number on it. That normal return is set at 10% of the value of all that tangible stuff. So let's say you've got a factory worth $1 million. The government basically says, okay, it's normal for that factory to make about $100,000 in profit. That's considered safe.
And right here, this is the magic trick. Any profit a company makes above that 10% baseline, that's labeled excess profit. And for the purposes of the law, that excess is treated as if it came from those easy-to-move intangibles, the patents, the brands, the software. That's the target.
Okay, so now let's see how this logic, this whole excess profits idea, gets turned into an actual formula. It might sound complicated, but if you just keep that core idea in your head, it's actually pretty easy to follow. All right, here we go, the 4 main steps. Step 1, you just add up all your profits from your foreign companies. That's called net tested income. Step 2, you figure out the value of all your physical stuff overseas, your factories, your equipment. The fancy term for this is QBAI. Step 3, you calculate that normal return we talked about. Just take 10% of your QBAI. And finally, the big finale, step 4, you take your total profit from step 1 and subtract the normal return from step 3. Whatever's left over, boom, that's your GILTI.
Let's make this real with some simple numbers. Imagine a company makes $900 in total foreign profit. And let's say they have $700 worth of factories and equipment. Okay, so what's the normal return?
10% of that $700 in assets, which is $70. So you take the total profit, $900, subtract that normal $70, and you're left with $830. That is the amount subject to the GILTI tax.
So who actually has to worry about all this? Well, the rules apply to what are called U.S. shareholders of foreign companies. But here's a really important catch. How GILTI hits you is totally different depending on whether you're a big corporation or just an individual.
And just so we're clear, when we say U.S. shareholder, we're not talking about someone who owns a couple of shares of some foreign stock. For GILTI, this means a U.S. person or a U.S. company that owns a big chunk, at least 10%, of a foreign company that's mainly controlled by Americans. It could be a giant multinational or an American entrepreneur with a business abroad.
And this right here is probably one of the biggest takeaways. If you're a corporation, you get some pretty significant breaks. You can deduct half of your GILTI income right off the bat, and you can use foreign taxes you've already paid to lower your U.S. bill. But if you're an individual shareholder, you generally don't get those deductions or credits. That GILTI income can get taxed at your highest personal income tax rate, which can be a much, much bigger hit unless you make a special tax election.
All right, let's just quickly run through the big takeaways here. First, GILTI was born out of the 2017 tax law to plug a brand new loophole. Second, it's basically a global minimum tax. Third, its whole clever trick is to tax excess profits, anything above a 10% return on physical assets. Fourth, it's really designed to go after that mobile income from things like patents and brands. And finally, and this is a big one, how much it stings depends heavily on whether you're a corporation or an individual.
So, that leaves us with a really big question for the future. The entire logic of GILTI is built around physical stuff, tangible assets. But we live in an economy that's more and more digital, where the most valuable companies in the world build their fortunes on code and data, not factories and machines. So the real question is, can a tax system that's based on things you can touch effectively tax a world that's becoming less and less physical? That's something policymakers are grappling with right now. Thanks for tuning in.